Good afternoon, everyone, and thank you for joining the webinar on navigating the Tax Cuts and Jobs Act. My name is Elaine Parker, and I'm the president of the Job Creators Network Foundation and the Chief Communications Officer for all of Job Creators Network. Job Creators Network is a national small business advocacy organization that was founded by Bernie Marcus. Bernie is also the co-founder of the Home Depot. JCN and our small business members were very involved in getting the new tax bill passed last year because we knew that it would help small business owners and help jumpstart the economy. Like with any big policy change, we have heard from many of our members that they're unsure of how this new law will really affect their business. And that's why we reached out to Julio Gonzalez and Jamie Pope from Engineered Services to give a breakdown of the changes and how you can take advantage of them. Julio is not only an expert in the law, he worked tirelessly on Capitol Hill to help write the law and get it passed. We hope to have a few minutes for questions at the end of the presentation. So if you have a question, please click on the Q&A icon at the top center area of the screen. And you can post your question in the chat box. We'll be monitoring the chat box throughout the presentation. All lines are in listen only, so that is the best way to get your question into the queue. The presentation is being recorded and will be posted on our website at jobcreatorsnetwork.com, and we will also email the presentation to all participants. I also want to remind people that this webinar is not legal advice, and before taking any action on any information, you should always consult with your own tax advisor. I now want to hand it over to Julio Gonzalez, CEO of Engineered Tax Services. Thanks, Julio.
Good afternoon, everyone, and thanks for joining us. I'm certainly proud to be part of the JCN Job Creators Network family and look forward to going through this presentation with you and sharing some helpful hints that hopefully will help you take advantage of the new tax reform. So here, first of all, accomplished. The tax bill, the tax reform was passed, and that's a great thing. I think the problem for small businesses is that it was passed at the end of December, and although that's a good thing, accountants and CPAs come January start working on 2017 tax returns and, get through those in April and then extend through September, October. So the problem is that we have an accounting community, a tax community that's still probably working on 2017 and then getting to 2018 taxes and tax returns. And so what we wanted to do is go the highlights from tax reform, some of the things that you should be talking to your accounting team about so that you can start to take advantage of tax reform and take advantage of the benefits. Education is the key, and what we want to do today is go over some of the highlights so that you can start to use tax benefits. So, quickly here, what did the Tax Cuts and Jobs Act do for tax bill? Here we go. Gave 80% of Americans the tax cut. We'll go through that in a little bit. Cut corporate tax rates for C corporations from 35% to 21%. That's a dramatic reduction in tax cuts. That's, we all know in business that the government's our partner. We want that partnership to be a great one. And for a decade plus, we've had very high tax rates. And as business owners, we know that with high tax rates, it's hard to save money and invest in your companies. And so this dramatic tax cut allows us to finally save and invest in our companies. Now, the tax rate from 35% to 21% was for C corporations. So, what the government wanted to do for pass-through entities was create a 20% deduction. That 20% deduction on net income tax or net income is for corporations the restriction is on the $315,000 of qualified business income for joint filers. We'll go through that in detail. On all other pass-throughs or most other pass-throughs, there's limitations based on W-2, and we'll talk through that. It doubled the standard deduction. The thinking there was if we take the standard deduction and double it to $24,000, that will allow most individual taxpayers to not have to go through the complicated process of doing a very detailed tax return. So the goal there was to simplify the tax return for individual filers so that they could not have to go through all the specific details of previous tax reform or tax code to file their tax returns. So big accomplishment there. It did limit the SALT deduction, state and local tax deductions, to $10,000. Now that's one of those issues that, had a lot of controversy. The thinking here was that Congress and Senate wanted to find ways to lower income tax rates. And one of them was to limit the state and local tax deductions. And the thought process there was that the federal government shouldn't be funding states with high taxes, and so that those tax benefits would be basically reduced so that we could get lower tax rates so that individuals and businesses could thrive. And I think that really is setting up for states to be more tax efficient in high rate tax states. So we'll go through that. It also doubled the child tax credit to $2,000 per dependent child age under 17. Allows business to write off or expense the full value of investment in new and used equipment. This is a tremendous tax benefit. Typically, when we're buying equipment and investing in our companies, we have to depreciate that equipment over a 3, 5, 10-year period. Well, when you have immediate expensing, that really allows you to preserve cash by lowering your taxable income. So when you combine that with the lower income tax rates, that's a huge boost for small businesses. We see that all the time in the media, throughout the JCN network, that businesses are retaining their cash through these benefits, hiring more people, increasing wages, and it's working. And so that's what we want to talk about today, how it's working and how to better take advantage of it going forward. So big opportunity there. It does cap business deduction for debt interest payments at 30% of taxable income based on businesses over $15 million. So here, again, Congress and Senate were looking for ways to get more money to Treasury to lower the income tax rates for small businesses. Now, this reduction in the ability to deduct interest payments is very impactful to the large corporations, and they're going to have to find ways to deal with this. And the thought here is that Congress and Senate don't want to see companies with big debt balances. They want to see more equity in our companies so that there's more success. And so their thinking is to modify large corporation behavior, and in that, doing so that they could create more money to get into Treasury to lower income tax rates for individuals and small businesses. And, obviously, for small businesses, that ability to offset income tax rates and immediate deductions through this trade-off, I think, is working well. It also eliminated the individual mandate for Obamacare, and we know how important that is. And JCN has been reporting this last month that there's even further health care benefits that are being passed in D.C. to help all small businesses. So exciting news above and beyond the tax reform. So let's go into this in more detail. what should I do to maximize the new tax benefits? I think these are questions that you want to review with your accounting team. One is, does my corporation structure still make sense? Because obviously there's been a lot of change in the tax rates based on corporation time. How do I take advantage of the work opportunity tax credits? Should I set up a 529 retirement plan and maximize retirement plans? Do I need to change accounting method? And how do I best utilize the new tax code to reinvest in my employees? Okay, so when we look at revisiting your corporate structure, we talked a little bit about personal service corporations getting some small tax benefit in terms of lower taxable income rates up to a certain threshold. So I think the issue here is, if I have a professional service corporation, do I want to set up an additional corporation, a C corporation, to shift some of the income that could then benefit at the C corporation 21% tax rate? And these are things you're going to want to do and review with your accounting team. An example I saw recently was a law firm that basically, because he's limited on the 20% pass-through fee by being a personal service corporation, he set up a C corporation for his paralegals where a bulk of the income came through so that he could at least mitigate the restrictions on the pass-through being a service corporation, and now taking advantage of the 21% income tax rate for C corporation. So these are things that you're going to want to visit with your accounting team and make sure that you're taking advantage of new structures to maximize the tax benefits. So I see this not being necessarily changing corporation type, but maybe looking at ways to add corporation types to maximize wealth preservation. Okay, so the work opportunity tax credit, this is a tremendous tax benefit, and, basically a $9,600 credit for hiring long-term unemployed people in certain demographics, right? So this would be disabled veterans, people on food stamps, things of that nature. So, again, if those type of demographics work for the people that you employ, to get this type of tax credit on their wages, which is a dollar-for-dollar credit, is phenomenal. So, again, this is an opportunity to take advantage of these tax credits and hire people that were previously unhireable. So this is a wonderful tax benefit. Setting up a 529 plan. Well, we've always had that opportunity, but now under the new tax reform, this 529 provision, really what the change is previously 529 was putting a savings program together for higher education. The new provision now allows you to use this money for private and religious schools that are not necessarily, higher educational institutions. So it's a tremendous opportunity for families that have children that are in private school or religious institutions. Change your accounting method. I think this is one of the best benefits that came along. When we have the cash method, that was previously only available to companies with $5 million of revenue or less. They shifted this to $25 million. So what does this mean? Well, for companies now that are over $5 million in revenue, but under $25 million in revenue, the great thing is, really it comes down to inventory. You can immediately expense inventory under the cash method, where previously, you would have to inventory it, not allow it to be deductible expense until sold, and that makes a tremendous difference for small business companies, 25 million or under, that have inventory. So a wonderful tax benefit for small business community. Reinvest in your employees. The JCN keeps reporting all the time about these companies that are investing in their employees, higher wages, hiring more people, taking advantage of the tax credits. And, mission accomplished. It's working. It's working at a high level, and it's just great to see. But again, there's some tools that we want to share with you today to make sure that you're taking advantage of these new tax benefits, not only in 2019, but today. So, other accounting considerations. One thing that did change in the tax reform is like-kind exchange, where we could, basically trade for properties without having to pay capital gains. Well, they restricted that back to real estate only. So 1031 used to be able to be used for aircrafts, vehicles, machinery, equipment, rail cars, artwork, collectibles, things of that nature. The change really was to get more money into Treasury, and I think it's a great trade-off. So now instead of being able to defer taxes on artwork and airplanes and things of that nature, boats, that money now goes to Treasury and allows us all as small business owners to take advantage of lower income tax rates and immediate expensing. So I think great trade-off there. Current year business operating losses, including non-passive losses, are now limited to $500,000 joint. Here the thinking with Congress and Senate was that businesses that are non-performing or, non-profitable, why should those, losses be able to be really a benefit? So they want businesses that are producing and hiring to take advantage of tax benefits and limit the benefits associated with non-productive loss entities. So again, look, in tax reform, you're going to have trade-offs. Someone's going to benefit, someone's going to not benefit. There's a trade-off there, and what the government was trying to do is make sure that benefit goes to small business owners and the individuals, and to mitigate, other types of entities taking advantage of, really tax dollars that would not go into Treasury. So I think those have been good trade-offs. The next item here, no carryback on net operating business losses. Carry forward of future losses limited to 80% of taxable income. Again, a good trade-off to get more money into Treasury, limit corporations that are non-productive, non-hiring, to get lower income tax rates. Okay, we talked about this for 2018, Section 179, expensing up to $1 million, unlimited expensing for certain properties, including used property. Big change, and this really allows us to all invest in equipment and manufacturing and software and computers to really grow our businesses. And even if we're leasing them or borrowing for those assets, to get to immediately expensing them obviously creates tremendous cash flow. So we're going to walk through the pass-throughs in a little bit more detail here, okay? So, as we said, for service corporations, this 20% reduction in the net income tax is, limited on professional service corporations to $315,000 for a married couple, and that for all of most other pass-through corporations, pass-through corporations, not service corporations, the limit is 50% of the taxpayer's share of aggregate W-2 wages paid by the business. So I think this threshold is going to be hard to meet, and so I think everyone's going to be able to take advantage of it. Or 25% of the taxpayer's share of aggregate W-2 wages paid by the business, plus 2.5% of the unadjusted basis. So again, high thresholds. I think for most 99% of small businesses, we're going to be able to take the 20% reduction in the net income from the business that would be non-taxable. Okay. Deductions apply at the entity level for anyone that has multiple companies. It also applies to property held at the end of the taxable year. Something new is that income from trust and estates on REIT dividends is eligible. That's brand new. And again, it does apply to service corporations, but they limit up $315,000 as shown above. Okay, well, I don't expect everyone to be able to read this, but, important that when you get this slide deck sent to you, that we've created a decision tree. And the decision tree basically allows you to walk through and make sure you're maximizing that 20% reduction in taxable income at the pass-through entity. So we also have tools, Excel models, and other handouts that will help you go through these decision trees, because the one thing you do is you want to get with the accounting team and make sure that your business is going to maximize every tax benefit, especially this 20% reduction from the pass-through rate. So an important decision tree, and again, a little difficult to read, but probably something when you get the handouts and ask for the different tools, I think it'll be a good resource for you and your tax team. Okay, so let's do a quick example here. So we have a company, multifamily firm, purchases an apartment building for $20 million and $14 million to structure, $6 million attributed to land. The building generates $1.25 million, in income. So here on this one, maximum deduction before the limitation is $250,000, which of course, so of that $1.25 million, we're taking $250,000 of it, or 20%, which is non-taxable. Okay, so we just have to make sure we meet the limitation calculation. So the maximum pass-through deduction would be $250,000, and the taxpayer gets the full deduction of the $250,000, regardless of wage limitations as it's related to real estate. So again, another tremendous benefit. And let's do one more example here. Assume a married couple are owners of a non-service pass-through business and have $200,000 in net business income. All right, so $50,000 wages, and they have no other income. It will have the standard $24,000 in deduction. Remember, that doubled. The taxable income is $226,000. So here, their qualified business deduction is equal to the lesser of 20% net business income, $40,000, or 20% of taxable income, $45,200. So their pass-through is $40,000. So again, having that decision tree and the tools to work through those differences, whether we take the $45,000 or the $40,000, or how do we make sure we get the $45,000, is real important. So again, good things to be looking at. The tax reform comparisons. And I think here, like for married filing couples, the biggest thing here is you see that in the middle ranges, right, in the income levels from $77,000 to $237,000, $238,000, the income tax rates have dropped from 3% to 4%. Significant difference, right? 4% means a lot to most families, and that's a tremendous difference. And again, here we see that tax reform was really geared for that middle class family to be able to save, be able to invest, and it really is highlighted here. Same for individuals. It's really for that middle class tier where the reductions are from 3% to 4%, ranging from $38,000 income up to $195,000. So big tax rate cuts there. For the higher income earners, a little less rate, and obviously that was really to stimulate middle class buying. Okay. So other things we should just know real quickly. Tax rate reductions, we talked about that one, 35% down to 21% on C corporations. Capital gain rates remain unchanged. Depreciation recapture rates changed. Net investment income tax remains unchanged. Now, moving expenses, where they used to be available to everyone, they've been moved only to really the military. So, again, here, there's a trade-off in tax reform, and the trade-off here is to limit some of these miscellaneous expenses so that we can all enjoy lower income tax rates. Okay? Itemized deductions have stayed fairly the same. We talked about this. Medical expenses, 7.5 of adjusted income from 10%. State and local, we know that was the big change, right? Changing from unlimited to 10,000 combined. Interest on home mortgage debt reduced down to $750,000. So that was also a change as well. And charitable contributions, on the other hand, went up. So instead of having it at 50%, we're up to 60%, which means we can all be more generous with the income gains that we're getting from the tax reform, and limit to casualty and theft losses accordingly. Here we show that, again, limitations suspended for AGI over certain levels, itemized deduction limitations suspended through 2025. And again, minor changes here for the lower income tax rates. And again, just to conclude this, we know that we've talked about this 20% pass-through is a substantial change in tax reform for all of us to grow our companies. Again, let's just remember 20% pass-through limitations on the personal service corporations, unlimited up to the limitations based on W-2 on regular pass-through companies. Again, very important. And again, use this slide, use our tools to make sure you're taking advantage of all these benefits. We talked about this as well, that 30% deduction on interest paid is now a limitation, but only for businesses over $15 million. Again, good trade-off. Now, for real estate, they get to take the interest deduction with no 30% limitation, although it does, through that election, cause them to depreciate their buildings just a tad bit longer. We talked about 179 going up to $1 million, and bonus depreciation 100%. So even if you go through $1 million of equipment purchases, then you can move to bonus depreciation to write off immediately everything else under tangible personal property rules. Okay. We talked about the 179 expensing, so up to $1 million phases out after $2.5 million. So a little bit of a phase out there, but significantly higher than previous tax code. And domestic production deduction repealed. That was basically a deduction for employment of U.S. labor on certain domestic production. A little bit of a trade-off there. But Jamie's going to talk a little bit later about the R&D tax credit and where that tax benefit was made up. The cost recovery here, big thing here, it says 10 years. That was what was hoped for qualified leasehold improvements, qualified property. This would mainly relate to restaurants, hotels, things of that nature. This is where we have a technical error. So it's not 10 years. It was intended to be 10 years. It's now 39 years. And Treasury, Congress, and Senate are working on Tax Reform 2.0 or technical corrections to get this solved. And as you guys probably all hear, technical corrections are being done now, so hopefully we get through that pretty quickly. AMT obviously was modified and increased so that on an individual basis, you don't have to file two separate tax returns to see what our net taxable income is. That's great. Estate giving went up from 5 to 10 million. And as we talked about, affordable care penalties reduced starting in 2019. Okay, so this is where Jamie takes over and talks a little bit about some of the other tax benefits associated with real estate.
Well, thank you, Julio. And without a doubt, changes in tax reform for real estate are some of the most significant benefits contained in the bill. Most of us that own real estate or own business buildings know that we can depreciate or write off the cost of that building over time. Real estate's one of the few of the investments in America that allow you to do so. That's the good news. Bad news, it can take up to 40 years to claim some of that depreciation. And depreciation, folks, is simply the process of recovering your business cost. So if you have a long depreciation, 40 years, 27 and a half years, it means that some costs are received many years later than when you actually made the expenditure, meaning, if nothing else, inflation eats away the cost of your recovery, so you overpay your income taxes. Quite simple. So cost segregation, as we've highlighted here in the headline, is basically the process of recovering your cost quicker based on their individual life as allowed by the tax code and identified in an engineer's study. So if you have a building, you can do the accountant's method, write it out over 40 years or 27 and a half years if it's residential rental property, or you can use an engineer's report, and that's where this bonus depreciation and other benefits come into effect. So basically, think of your building as made up with Legos in different parts. Some of those parts of the building won't last 40 years. They'll last 5 years, others 7, other 15. So what we do is break every part of your building down, like putting it together with Lego blocks, and the blocks that are 5 years, 7 years, and 15 years, we can write off sooner than 40 years. But now we receive bonus depreciation on those items as well, which means if you buy another building or construct another building, not only can you write the short tax life items off sooner, but you're also going to receive 100% bonus depreciation on those items. Tax experts tell us by doing that, you may be able to recover as much as 10 or 15% of the total cost of a structure in year one, and that's significant. Next slide, please. So, new construction or purchase of new property previously was generally a 50% bonus depreciation allowed. Now with tax reform, those items have 100% bonus depreciation. Next slide, please. Next slide, Todd. Thank you. Qualified leasehold and retail improvements. Some of those will have, if they're acquired and placed in service after September 27th, 2017. And that's a key date. So anything you did toward the end of last year, you and your tax team need to review the dates on when those were actually done or a sales contract was signed to see if you'll be eligible for the new 100% bonus depreciation on that property. There are some technical changes that have to do with what's known as qualified improvement property. That was not the intention of the tax bill, but it was poorly worded in the end and caused some confusion, and there are a lot of people working on that in Tax Reform 2.0, and more guidance will be laid down later, and your tax team can review that once those regulations are handed down. Next slide, please. Qualified restaurant property, again, 100% bonus depreciation if you improve your restaurant, and some of those items fall in that 5 to 15-year category. A great bonus, a great way for those of you who are looking to improve your existing properties. Next slide, Todd. Deductibility of business interest, we covered that previously. The important thing to remember is this. Most small businesses will still be able to deduct 100% of their interest costs. They fall well under the thresholds of gross receipts, so it does not affect them. If one does rise above that level, then the depreciation method just means instead of those Lego blocks of 5, 7, and 15-year property, you'll be able to depreciate those items quicker, but instead of those periods, it'll be 10-year and 20-year periods. Next slide, please. Bonus depreciation of capital expenditures is so important, and as well as the 179 property. 179 property is now fully expensable in the year that it's incurred up to $1 million, and it phases out after $2.5 million. But the important thing that was in the new Tax Act that everybody should be excited about if they own commercial property, previously, roofing, security systems, HVAC had to be depreciated over a long period of time. Now those three items can be depreciated in the year that they're expensed. So no longer putting a roof on your building and writing it off over 40 years. Now those large expenses for roofing, HVAC, and some security systems can be written off in the year they're acquired. Again, that quicker depreciation means you're recovering those costs you're writing checks for today, so you won't be overpaying your federal income tax. Opportunity zone investments. Every time there's a major change in the tax law, there's always something in there that a few months later people go, wow, that is great, and this is it. Now, the great news of the opportunity zones, it's available, but there's still a number of rules and regulations on these that will need to be handed down by Treasury. So, again, this is one of those you'll want to stay in close touch with your tax team. JCN will be releasing updates as they are known. But the idea behind the opportunity zone is for us to take some of the trillions of dollars of capital gains tied up in existing investments, unlock them, and give investors incentives to take those dollars and put them to work in low-income or underserved areas in America. What that means is that for many people, they'll be able to harvest a current capital gain, whether it's a building, a business, or $1 million of Apple stock. You'll be able to take those gains and enjoy tax deferral on them for several years. If you take them and put them in an opportunity zone investment, qualified investment, all of your gain on that new investment, if it's held for at least 10 years, will be tax-free. Again, the new investment held for 10 years or longer, when you harvest that gain, it will all be tax-free. There's a lot of moving parts to this, but we'll keep you posted as rules and regulations come down. Probably for folks on this call that already own real estate and are perhaps using a 1031 tax deferral strategy, there's an opportunity here to sell a building, continue tax deferral for several years, but also receive a step-up in basis on that new investment. Previously, folks using that strategy, their exit strategy, if nothing else, to get a step-up in basis was when they died, their heirs would receive a step-up in basis. This allows a possible full step-up in basis for people in their lifetime. Next slide, please. We added some question and answers here, and this is not a complete list at all. There are many other questions many of you will have, but this will give you some starting points to reference in order to exactly what this Opportunity Zone Fund investments might mean. I personally receive 6 to 10 phone calls every day from accountants, real estate investors, other people around the country wanting to know. Zones have been identified. If you'd like, we can send you a link to a map, and you can look in your state, your area, and find out what the governor in your state has approved as qualified zones for these investments. Next slide, please. Research and development tax credits. The research and development tax credit has been in the tax code since 1981. It was designed then and still is a wage-based credit to keep jobs here in the United States. What those credits actually do is they're a dollar-for-dollar offset on a portion of payroll that goes to what's known as qualified activities. So think of the hard sciences, such as what architects and engineers do, software developers, technology firms, drug firms, many contract and other type of manufacturers. A portion of what they do qualifies as well. Many times folks, small business especially, don't know they're even eligible to receive these, but they are. And so these credits help you offset your federal income tax. If you're a new company that's been formed for less than 5 years and have gross receipts under $5 million, you can actually use these credits to help offset your federal payroll taxes if you're still in a net operating lease or net operating loss situation, and many small businesses stay that way, but Congress wanted to help you out and let you take this money and help offset federal payroll taxes. Next slide, please. And so that's an overview of what we have found in the Tax Act. And so at this point in time, we're going to open the floor up for Q&As. Elaine?
Thanks, Jamie. Julio, we're going to begin with some of the questions that have been submitted into the queue. I just wanted to ask you if you can see them.
Yes, I can see them, and quite a few of them. Here's one. What can we expect from Tax Cuts 2.0? Well, Congress has been pretty specific about what they want to have happen in Tax Reform 2.0. First of all, they want to show that tax reform can happen annually and not every 30 years, and that as things are working or not working from current tax reform, the current tax code, that they can change it, much like they do interest rates all the time, to make adjustments and make sure that we're changing tax reform as needed to continue to keep good growth, good job rates, and all that. So that's one thing. They want to make it permanent on income tax rates and some of the tax expensing, so that businesses know that, a lot of the benefits of tax reform sunset and expire in 5 to 10 years. So they want to eliminate those sunsets or those expirations to make sure that people know long term what their tax rates are going to be and not have to guess what happens after 5 to 10 years. So that's really important. They also want to make sure that they give more incentives to entrepreneurship, and that can be in the form of research and development tax credits and other credits to help continue to spur small businesses. And they also want to impact younger people investing in their retirement sooner and give more incentives for that. So those are the key highlights from Tax Reform 2.0. I think the key thing is, can we do tax reform every year and not every 30 years, so that we're always fine-tuning our economy and the strength of our country. So that's Tax Reform 2.0. Are all service businesses ineligible for tax cuts, or just certain service businesses? Well, I think that's a great question. We will send out with this slide deck the definition that now we have from the government on what is a certain business and what is not. Under it seems to be primarily doctors, accountants, lawyers, things of that nature. But we do have the language, and we'll include that when we send out this slide deck to everyone. Another question, how can I print out these slides? I think we'll be sending these slides to all the participants so that you can print them and be able to have those for your review after the webinar. And another one here, are there any significant regulations or rules that are left to work out in the new tax bill? Well, this tax bill was certainly rushed to show that, we could get something done prior to the end of 2017. And so there were certainly some technical errors made along the way that are trying to be corrected. I think the biggest one is qualified leaseholds and qualified property, where the goal there was to have that expensed immediately versus the 39 years based on just errors in language. And that would be a big part of what needs to be done. Certainly they're looking at more and more ways to cut down regulation, and you see that all the time, and hopefully that's part of what will get passed over the next couple of months before the midterm elections. And how does the new law deal with capital gains? Capital gains, for the most part, have stayed primarily the same. There's some minor changes, and we can certainly include that with the handouts. So those are, some of the questions I highlighted, and but we'll certainly be able to take questions offline, of course, and JCN wants to be that resource for you in terms of education and providing feedback all the time on how to take advantage of tax reform and how to continue to take advantage of all the new regulations or less regulations and changes to healthcare. So, great questions. It's been a great webinar. I hope it's been helpful in terms of the highlights. And again, we have tools to help with all this. And so, Elaine, I'll let you take it from here.
Thanks, Julio, and thanks, Jamie. Really appreciate your time today. I hope everyone has enjoyed the webinar. If you do have additional questions, you can send an email to info@jobcreatorsnetwork.com. In the subject line, just put webinar question, and we will forward all of those to Julio to answer them. As always, discuss this is not considered tax advice, and you should discuss your person with your own tax advisor. And if anyone is interested in joining Job Creators Network, you can go to jcn.com. As I mentioned, we're a small business advocacy organization, and we advocate on behalf of small businesses, and we are actually looking to amplify small business voice so that we can let Washington hear what small business owners need in terms of economic help. Again, thank you so much, and I hope everyone has a great day.